In continuing with monetary policy, let's look at the two other traditional tools of monetary policy, which are open market operation and changing the discount rate. Okay, we'll cover the discount rate first because it's the easiest one, and then we'll go over open market operations and quantitative easing. Okay, quantitative easing is not a traditional tool that the Fed uses, but they've used it recently, so it's definitely something that we'll be covering. All right, so let's look at the discount rate. The discount rate is the rate at which the Federal Reserve loans money to other depository institution. Okay, so the discount rate is the rate that the Federal Reserve loans money to other banking institution. So if they were looking at expansionary policy, as opposed to contractionary, okay, so we have expansionary fiscal, monetary policy and contractionary. And here, if they are manipulating the discount rate, if they decrease the discount rate, it's going to be expansionary policy because this will allow banks to borrow, make loans, and increase the money supply. Okay, with contractionary policy, they would want to increase the discount rate. Then not as many banks would borrow from them. That would discourage banks from borrowing from them, and then there wouldn't be loans being made on that. So the contractionary, the money supply would start to decrease. This is the weakest tool that the Federal Reserve has. The reason that it's the weakest tool is it's a very passive tool, meaning that they can't make banks take out loans. They can't make banks take out money from the Federal Reserve. And also, banks usually borrow from other banks. They don't actually borrow very much from the Federal Reserve in general. But it is still a tool of monetary policy. However, it is the weakest tool. So now let's look at the buying and selling of government securities. Okay, the buying and selling of government securities. So these are going to be T-bills and T-notes. Short-term government securities that are not risky at all. So basically, the Federal Reserve is going to take new cash and infuse it into the market, and in exchange for that, take a government security, or they're going to they're either going to be buying or selling government security. So obviously, if they are taking the government security from a bank and giving them cash, this is expansionary policy. So this is when the Federal Reserve buys government securities. And obviously, when they sell government securities, this is going to be contractionary policy because they're going to be pulling money out of the banks. Now, the way that they are pulling money in and out of the banks, if we were to take two different banks, we'll call this bank number 1, and this over here is going to be bank number 2. The banks borrow from each other, and when they borrow from each other, they borrow by what's called the federal funds rate. So this is the federal funds rate. And this is the interest rate that that the Federal Reserve is always trying to manipulate. The way that they do it is by infusing more cash into the market or by taking cash out of the market. If they are putting more cash in, if they are putting more cash in, taking securities out, so this is going to be government securities that they're buying from the banks, then they're putting more cash in, that's going to cause the money supply to go up, okay? As they are taking the cash out, obviously, when they're taking the cash out, it's going to be contractionary money supply so that the federal funds rate is going to increase. So when they sell the bonds, they are going to increase the federal funds rate. So when they buy government securities, they're going to lower the federal funds rate. Okay, and this is the tool of monetary policy that they do the most often. Okay, this is the target federal funds rate. It's usually a target somewhere between 2 and 2.25%. Well, as the economy's been having problems over the last 5-10 years, we've seen that the federal funds rate has been decreasing, decreasing, and decreasing. And once it hits 0%, it can't go any lower. They can't manipulate the federal funds rate at all anymore. Well, they could manipulate it upward, but they still want to maintain a low federal funds rate. So now we see them doing something that's called quantitative easing. And quantitative easing is when they infuse more money. So we're back over here under expansionary policy. They're infusing more money. However, instead of doing it through short-term securities like treasury bills and treasury notes, they're looking at a little bit longer term securities, so maybe 10-year securities instead of 1 and 2 or even overnight securities. They're looking at a little bit longer securities. So, and they're not necessarily staying with treasury bills and treasury notes. They're looking at mortgage-backed securities or even buying corporate debt in order to infuse money into the market. So that kind of works twofold. One, it allows them to manipulate long-term yields on whatever market they happen to be going into, whether it's mortgage-backed securities or corporate debt. It allows them to infuse money into those markets to allow them to operate a little bit more efficiently, and it also can give the Federal Reserve the ability to kind of influence long-term returns on these long-term yields in order to stabilize a longer market. Okay, so monetary policy, the most efficient tool is changing the reserve requirement. They never use that. So the other two tools, the discount rate and the open market securities, well, the open market securities is the one that they use the most often. However, it's not as effective as the other tool of changing the reserve requirement, but the Federal Reserve does not want to do that. So this is the one that they choose to use the most.